Hey everyone, this is Stephen Roddy, co-founder of Modern Beauty Con, and today we've got a special guest. His name is John Hutchinson, and many of us know him as Hutch. He is the founder of BankingTruths.com, where he simplifies complex financial strategies through visuals, stories, and straight talk. And Hutch isn't just a pro in the financial space; he's a client of the strategies he teaches and is a student of the ever-evolving world of wealth building. His passion for financial education is deeply personal. After witnessing his father's business unravel due to a lack of proper planning, Hutch made it his mission to understand money at a deeper level, and I totally empathize with that. I saw my dad go through something similar. And that journey led him into the financial industry, where he's earned some of the highest credentials and, more importantly, earned a reputation for putting clients like me first. And in 2012, he co-founded an independent boutique firm to break free from big bank agendas. And by 2015, he launched BankingTruths.com to share honest, visual financial education with the world, especially with business owners and real estate investors who he believes get the best returns from the things that they can control fully and buy in that. And he lived in California with his wife 21 years. 2-1 and three
22
daughters.
as of tomorrow.
Oh, 22 as of tomorrow. Okay. And he's got 3 daughters, and he's not talking about wealth. You'll likely find him playing pickleball, poker in Vegas, which he just got back from, and exploring just the world with his family. So Hutch, welcome to the call.
Thanks for having me, Stephen.
Absolutely. So to dive in, just in order to set the context for today's interview, could you just give a brief overview of what velocity banking is and infinite banking for those that maybe don't know?
Sure. Yeah, a lot of times people collapse the two, but they are actually two distinct things that came about around the same time in the 90s. So velocity banking was a way to accelerate paying down one's mortgage. And it actually started overseas, I believe in Australia, and made its way over here to the States. And what it talked about was essentially making extra payments to your mortgage by borrowing against a HELOC. And so it seems kind of weird and counterintuitive to get out of debt. You're going to borrow from another source to knock out debt, but it has to do with how that debt is calculated. So I don't want to go too deep right this second between amortized and simple interest loans, but because of how mortgages are calculated, with all the interest being front loaded, you could accelerate that by making extra payments. And so by borrowing against a simple interest loan, the math worked out that as long as you were consistent with the strategy, you could pay off your mortgage sooner. Now, we're in an environment where that may make sense again, where mortgage rates are in the 6, 7s, approaching 8%. But obviously, like my mortgage is 3 3/8, I'm in no hurry to accelerate that. In fact, it feels almost like free money. But the principles of velocity banking, what came about is that there's a sequence and a timing to how best to manage your cash flows. And we actually have, if you look up difference between velocity banking and infinite banking, or what is velocity banking, you'll probably find a Banking Truths article. We really do a good job of explaining not only the history, but how it applies to modern day techniques. And that could include like using credit cards and using insurance products, which is a good segue to infinite banking. So infinite banking came about at the same time as velocity banking. And what it talked about is using an insurance policy to act as your own private bank. Now, unfortunately, like people mistake this like you're getting off the grid. You're never really getting off the grid. There's still going to be a bank intermediary. So when you pay your premium to an insurance policy, you still have to pay from a bank. And the insurance company takes your premium and they're depositing in their bank account. But the idea is that the savings rates that are available by banks, they're actually decent now and call it in the 4% range. But for the last, call it decade and a half, the savings rate started with a dot. Versus with insurance products, you could get 4 and 5%. Now, the numbers are very similar today, what you can get with insurance products, what you can get with banks. But one of the big advantages of insurance products is there's no tax on that growth, because Because insurance products provide for widows and orphans, they incentivize you, so to speak, to save in insurance products that don't go away. But the phenomenon of infinite banking is the idea that if you run your cash flows through an insurance policy as opposed to like depositing and withdrawing with banks, you'll actually end up with more money at the end. And that is something we can look at and something we can prove. It has to do part because of the tax arbitrage, but it also has to do with what Einstein called the eighth wonder of the world. It's actually a mystery whether he called it the eighth wonder in the world or he called it the most powerful force created by man. But he was obviously enamored with compounding. But the idea is that when you're borrowing against an insurance policy, your full balance is still compounding for you in the insurance policy. And so when you pay down the loan, you actually end up at a higher place in line than if you had exhausted savings and refilled savings and exhausted savings and refilled savings. You kind of are on this hamster wheel where you never really kind of get any critical mass. You never really get compounding. And as soon as you do, you have to use your money for other things, whether it's infusing your business, sending kids to college, making major purchases for equipment or vehicles or whatever that may be. And the idea is if you ran the same cash flows of I call it the saving, spending hamster wheel, if you run that through an insurance policy and borrow against it, and I realize people hate the B word, the borrow word, you actually end up in a higher place in line because that full balance is compounding for you the entire time. So that was a lot.
Okay, so that's great. So let me just make sure that I understand this from a layman's terms, and most of our listeners will just be a very new concept. So for the purpose of this, just as an overview, velocity banking is if I have a home equity line of credit or maybe a business line of credit that I can leverage to pay down maybe a device or my commercial property or my residential property faster by borrowing against that. Is that correct for the first?
Yes, it is correct in its true original form, where I would say, Stephen, where we take it to the next level. Certainly, if you read the article, that's easily searchable on the web.
Yeah.
It's more about the principles of understanding how different forms of debt are accrued. And so you could use things like zero interest credit cards, or even if there's zero interest credit cards. Most people don't realize that the interest doesn't accrue against you until the statement date. And as long as you pay the statement balance by the statement date, you actually get a free float for about a month. So it's really all about understanding the different debt instruments that you have, or call it cash flow instruments, because people don't like the D word either. Understanding the different your parameters for the line of credit, the credit card. You could pay down a commercial property, but the problem with that is as soon as you do, it's hard to get it back. And so most of my clients that really understand these things are trying to call it gamify cash flows, really put a premium on liquidity, access, and control. Certainly business owners do. Now, obviously, if there's a device at a very adverse interest rate, maybe you do want to knock that out. And so you can use these other instruments and look at the sequence and timing and how interest is accruing there, and start to gamify and build out a plan to most expeditiously pay down the device without strangling yourself from a liquidity standpoint. Does that make sense?
It does on the surface level. As much as I can. So you're basically playing the game of mathematics. So let's bring this down into some just real world examples. So like, how can a med spa owner like use maybe infinite banking or velocity banking, let's say to pay down a device or that they purchase? So a lot of these lasers will cost like $200,000, and then they get they're a high interest rate at like, well, I mean, a few years ago, they're 9 and 10%. I'm not sure what they are now, but like, so
probably 15, 18, right?
Yeah, could be. I haven't looked at that for a while because all of ours are paid off, thankfully. But that said, let's say if that they do are in a, let's say, just a 10% interest
Mhm.
rate. How could they leverage some of these principles to pay down that debt faster?
Sure. So, using some of the tools that I mentioned, a lot of them will have great credit scores, and so they may have some 0% credit card offers that
Hmm.
are available to them, and they might take that full offer, right? That full 0%. Usually, there's like a 3% kind of one-time charge for an 18-month 0%. Well, now all of a sudden, that's cash in their world that they can use to pay off other expenses. If they did it personally, they could loan it to the business, or like if they don't want to do a cash advance, maybe they just maybe they use those cards to pay off some of the expenses they would normally wouldn't pay off, and that would free up some personal cash flow to then loan to the business to then pay down some of that money. And essentially they're getting an 18-month float at a flat 3%, right? It's not even annualized because it's 18 months. So that's a really simple way. You're going to get capped out pretty soon with that technique. But you mentioned a business line of credit. If they have a business line of credit and it is at a lower interest rate, there's an arbitrage possibility there. And going back to something I said I wanted to defer in the beginning, if the equipment loans, are they usually amortized, meaning like it's like when you buy a car, like it's a 60-month loan and there's set principal and interest payments?
Yeah, I've seen it where it's like, doesn't matter if you pay off early or not, you're the
Mhm.
same amount of interest. And then the other way is like a car loan.
Yeah, so if it's like a car loan, then it's an amortized loan, and then there is an advantage to go ahead and make those extra payments early. And so that is true velocity banking. You'd be borrowing from a simple interest line of credit, even if it's at the same rate, since one is simple interest and the other one is amortized interest, where people realize with their mortgage, like that first payment, even if their mortgage is 3 or 4%, they look at it and they go, wait, 80% of my payments going to interest.
Yeah.
And you would essentially knock that down or accelerate that by borrowing against a simple interest line of credit to go ahead and pay that off sooner. So those are just a couple of examples of how to take a velocity banking approach to that problem.
So one of the things that I did, and feel free, like if this is the wrong strategy, like I want to know,
Mhm.
like use me as a teaching. Um, so we had our last device. I think we owed maybe like $60,000 on it, and so we have $100,000 line of credit for our company. And what I did was I used the line of credit to basically to pay off that device. So now I wasn't paying that. I think it was like 8% interest,
Okay.
whereas the line of credit was about 10% interest at the time, like
Mhm.
when I did it. So, but instead of that money just hanging out in like the savings or like the checking, what I did is I shifted it all like to pay off the line of credit, and we still had like some extra left over. Not a lot, but there was some extra that was left over. So then my line of credit was at zero and my debt was at zero. And my mindset when I did it, I'm like, well, I'm saving $300 a month in interest. And
Yes.
so like that's $3,600 a year. And then there were times like if payroll hit, credit card hit, and some other things, right? I would dip into the line of credit, but I still wasn't that full 60,000. It might have went up to 10,000 for
Yeah.
a few weeks or whatever and then back down. Was that the right strategy, or
So
would you advise differently?
this is where we get into gray areas. And so I'll tell a tale of a couple different Stevens.
Okay.
So if you're putting the priority to just knock out debt at all costs, 100% that was the right strategy. If liquidity and control was the goal, like say you were going to expand soon and you needed maximum liquidity, then maybe you go ahead and pay that 300 a month. Maybe it's worth it for you to make sure that you have all sources of liquidity available. And the
Right.
one they can't ever take away from you is the personal savings. And so the only reason you wouldn't do it is if capacity, liquidity was more important. Then you may go ahead and just pay that interest, knowing that no matter what, you have this savings. And this is where velocity banking intersects with infinite banking. Is sometimes borrowing against the insurance is let's just say more expensive, like sometimes we'll just use the car loan. Sometimes there's a 1.9%. Well, you would absolutely do the 1.9% as opposed to borrowing against the insurance. But even if it was 9.9% for the car loan, once you take the car loan and you have terms that you know you can cash flow, it still may make sense to pay the 9.9, knowing that they can't ever take away your personal line of credit using infinite banking or insurance. So even though, and this is where math is not money, money is not math, and emotions actually play a part. And so a lot of times the pay down debt, when you really unpack it, a lot of times it's an emotional response. So it was passed down from our ancestors, our post-depression, grandmothers and grandfathers, who kept all the money in the coffee can and didn't want to lose the family farm. And so it's been kind of hammered into us to just get out of debt, get out of debt, get out of debt at all costs. And so you see people, paying down mortgages at 2 point something percent, which is like, oh no, don't do that. Like
Free money. Yeah.
Yeah. Keep liquidity invested in just about anything, but people psychologically want to get out of debt. And what I'm saying is sometimes the math may say it is better to get out of debt, but when you part with your liquidity to go ahead and do that, you never really know for sure if the bank is going to continue to extend the lines of credits that they've extended to you. Like I had a HELOC in 2009 where I was only at about half the balance and I was current on my payments, but because global credit markets froze up, they actually just said, well, you don't have to pay off your HELOC now, but we're not going to give you the other half. So we're kind of freezing you where you're at. And so as a business owner, you have to kind of assess where you're at in the business cycle. Like Bob Hope has a great saying. I love this saying: a bank is a place that will loan you money if you can prove you don't need it.
Yeah. My mentor was like, a bank is not your friend. They're not your enemy, but they're not your friend. The bank is always going to be out for the best interest of the bank.
Of course.
Okay. So let's say someone doesn't do a Steven and take the whole and pay it off. Is there some way to kind of back into what's a good number to scrape off? If you want to maintain control, you scrape off $10,000 from your line of credit, pay down the device, the interest payment goes down. Is there a way to kind of back into how much from that line of credit you should peel off, pay towards that machine debt?
Yeah. I think it's very personalized, but you gave me some clues earlier. And so you talked about how you were making payrolls. And so you can look at your company's monthly burn rate and then kind of equate that to the line of credit of like, where do you really feel comfortable?
Can you explain what a burn rate is for somebody that maybe doesn't know?
Sure. Yeah, that makes sense. So whatever your monthly nut is for the business, making payroll payments, paying all the interest payments to, like, if you're just paying minimum on all the machines, the rent payment, everything else that you're paying, you have this kind of monthly burn rate that is you're going to need to come up with as a business owner. Like your employees, they're not profit sharing with you, or even if they are, they still want to get paid on every other Friday or whatever it is. And so what I would do, or what I would recommend my clients do, is to really figure out realistically, like, hey, if cash flow just stopped coming in for whatever reason, how many months could I survive and maybe keep that amount available in the line of credit, keeping in mind that in the worst case scenarios, your bank could shut that down at any time too. And again, this is the reason to build up outside your own personal line of credit with infinite banking and insurance policies. Heck, even if you just kept it in a high yield savings account, we can prove that mathematically it's not as efficient as doing in the insurance vehicle, but making sure you have something that can't be taken away, worst case scenario, so you can handle your burn rate.
Okay. So let's say that the med spa listening, that they have $10,000 left over at the end of the month after they've cleared through all their expenses, and they look at it, they're like, all right, I average around $10,000 a month. So based on that surplus, and then let's just assume that maybe they do have 3 months worth of expenses in savings, like stored up in case another COVID happens or something else. how would you back into how much they should peel off their line of credit and throw against that machine debt?
Yeah, again, it's a personal, it's very personalized. Like I would
Hmm.
actually look and see how many levels deep they could go, so that they have liquidity no matter what. And again, going back to their own, call it desire. Like if this debt is just has them seeing red, then I would
Hmm.
have them go pretty aggressive because that's their main goal. I would caution them if they're leaving themselves with no reserves that can't be taken away from them. And by the way, insurance is just one of them. Another call it emergency place of reserves that most people forget about because it's one of these, oh, I don't know, how you call it, but just like kind of a holy grail of finance. The 401k loan is a great place for a business owner to tap into, and especially if the spouse is also employed. So you're allowed up to a $50,000 401k loan for each participant. Now it assumes you have double that in your account, but if you had $100,000 401k balance and your spouse had $100,000 401k balance, each of you could pull $50,000 at any time. And so even that as like a complete backstop line of credit, having that extra 100 grand like has me feel better about paying down debt that you
Yeah.
can't get back if you absolutely need it. But going back to your question, there's not like an empirical answer. It's more, call it facts related, not just the hard facts of what numbers they have in different places, but really the soft facts of how they feel about that debt and how they feel about liquidity and if they need it for expansion or just peace of mind. Does that make
Yeah.
sense?
No, that makes sense that you need to do it as a case by case basis. So in essence, what I hear is like, okay, if debt is keeping you up at night, and for me, I hate it when I feel like I'm just throwing money away. So for me,
Mhm.
I'm like, okay, there's a better way to do this. I want to get this off my books because now, like, our spa is $3,600 a year more
Mhm.
profitable by just paying that off. So, like, I that to me is very energizing. So I'm like, all
Yes.
right, let's attack this thing. And I have a really high risk tolerance. So I'm like, okay, let's just go for it. I'll figure it out if worst case happens. And then, but if somebody is more like, I'm not sure, and then maybe they're making $10,000 extra left over a month, maybe what they do is like, all right, out of that 10, maybe you take like 5,000 and then you throw it towards the loan. So you're still tucking away 5,000 over there, but then 5,000 is getting thrown against the loan. Is that?
Yeah, that's one way to look at it, and I get that. So I always respect somebody's emotions rather
Mhm.
than the math. Like if it's keeping you up at night, it's not even worth it. Just like knock it out. But another way to look at the same scenario is even if they're paying 3,600, but that machine is kicking off whatever 8,000,
Yeah, worth it.
it's worth it. And so for the med spa owner who is looking to expand, I would have them pay off zero. Like the machine's still cash flow positive itself,
Hmm.
but having the liquidity to be able to get another machine
Hmm.
either at the same building or a new building is going to create more positive cash flow in the future than knocking out the debt.
Love that. Yeah, that's really good. So almost like looking at each individual device as like its own separate business. Like, all right, this one device is cash flowing in and by itself. So, if you don't have the extra surplus, why let it keep you up at night? That's great.
Yeah, and there's the typical very simplified think in abundance, think of scarcity. So I've nothing against paying down debt when all avenues of abundance and expansion have been thoroughly looked into and explored. But if you think about it, you can only pay down debt to zero. But when you're talking about growth and expansion, like that is infinite. And so your liquidity is your, call it access, your tools, your key to be able to do that. Going back
Hmm.
to a bank is a place that will loan you money if you can prove you don't need it. But you also have to show liquidity and reserve. So in order to be able to borrow enough for another machine on its own, even if they charge double the interest rate, it may be a great decision for the business owner. So
Yeah.
rather than hard charge to pay down one, it might be a more powerful conversation long term overall. Like you even said that you're not risk averse to look at the expansion avenue first before paying down the contraction of the debt, if that makes sense.
It makes perfect sense. Okay, so you've talked a lot about insurance, like leveraging this, and um, now break down what kind of insurance and maybe how they can actually accumulate wealth to the point where they can loan money from that policy.
Sure. So it's interesting. We're talking about business owners. I have a great article that talks about early infinite banking before it was a thing. So like infinite banking is a thing, like we talked about, it came about in the 90s, like velocity banking. And that's when it was really a term. But at the end of the day, what you're doing is you're borrowing against one asset while letting another compound. Like that's what's happening. That's what people do with real estate. Like I have a lot of real estate investor clients, and just similar to the machine talk, they understand they're going to have debt service for every property, and they're happy to do that because they know they're getting a bigger bite of the apple coming the other way. Well, most people don't think about doing that with insurance, but if we look back in history, I have a great article about 3 iconic entrepreneurs who used insurance before infinite banking was a thing to either start, grow, or save their business. It was Walt Disney to start his business. In fact, there's a great it was a great thing in the Disneyland, I forget what it's called, Disneyland source book, but it said that Walt was going from banker to banker talking about his dream and his vision. And I was trying to imagine these conversations like, hey, there's going to be a mouse and a duck, and you're going to be in a little golf cart going through it. And they're like, yeah.
This guy's crazy.
Yeah. And he said, what did he say? And he said, bankers wouldn't lend me money because dreams offer too little collateral. And so he actually had a well-funded whole life policy. So you can't use term. Term is just like rental insurance, almost like car insurance, right? It's just kind of like a temporary contract that you have and you have to kind of keep renewing. That's what term insurance is. But whole life, and there are different types of permanent insurance that can work well, but whole life is traditionally, that's the old plain vanilla life insurance. In fact, the old school name for whole life was called ordinary life, which is weird because, insurance companies are horrible marketers, ordinary life, because everybody wants to be ordinary, right?
Yeah.
But whole life is a really interesting vehicle because it has a guaranteed growth rate, and it's guaranteed to go up every year no matter what. And what's interesting about whole life is when you buy one of these policies, you're actually part owner in the company itself. And so you collect dividends. They aren't guaranteed like the guaranteed growth. That is guaranteed. But dividends are non-guaranteed, and they're declared annually by the company based on their investment experience, their mortality experience, how well they underwrote, how many people died versus how many people they had scheduled to die, and just how well the company manages their expenses. So Walt had one of these policies. It had equity, and he realized he had to borrow against his policy itself he hired artists to further develop these dreams, and eventually he did get loans from the bankers. So that was one. Ray Kroc of McDonald's, the guy who bought out the McDonald's brothers, the movie with Michael Keaton, that was Ray Kroc. He actually had a large whole life policy, and it's notated in history that he actually didn't pay himself a salary and borrowed against his own key man policy. And we'll have to revisit that because that is going to be important for med spa owners. He borrowed against that to finance the Ronald McDonald Marketing Initiative, which I think under today's terms, it would be kind of creepy. But when I was a kid, that like Ronald McDonald was a thing.
Yeah.
And he actually borrowed against his life insurance policy to make that a reality. And J.C. Penney, to save his business, it's notated in history that he had invested heavily in the stock market, heavily in Florida real estate. It's crazy what's old is new again. And he had a $3 million whole life policy, which doesn't seem like a huge one, but back then that was massive.
Yeah.
And all of his other investments lost 90% in value. And his best investment, like when you're reading my bio, for a business owner, your number one investment will always be your business. Like you might get lucky here and there with some kind of crypto or a pot stock or whatever, but for the most part, your business is your cash cow. And so when the sky was falling all the way around him, he was able to borrow against his whole life policy to fund his operations. And obviously it endured, turned into a multi-generational family legacy, and public company today. I didn't realize they went through distress, but JC was able to save his business, James Cash Penny, through whole life. So that is the typical vehicle used because of the stalwart guarantees. Again, the tax forgiveness is afforded to any kind of permanent life insurance policy. But because it goes up every year, no matter what, people tend to like that because it is a source of liquidity. And if you're going to be borrowing against it, you can borrow against stock accounts, but you have to worry about, like, you might get a margin call. With life insurance, you can borrow 95% of your cash value at any time for any reason. No Bob Hope issues there.
Yeah, like when I borrow against mine, I literally send off an email. They're like, okay, yep, the money will be in your account, like, 24 or 48 hours, like whatever. And there's no questions, there's no like credit check, there's just like, oh, okay, yeah, it's your money, you can have it. And then, you just make payments back. And the cool thing about payments is, one, it's not a regular payment, it's not like a monthly payment. You have to pay a certain amount every year, which that varies. But the other thing I think it's important to note is it's not just a whole life insurance policy, right? It's like an overfunded. That's like the better, right? So that's how it builds the cash value the fastest.
For sure. So it's riding on the rails of an ordinary whole life policy, but we do add special riders to be able to juice up the performance and really fast forward the performance. What's interesting though, so the riders that we use is a term insurance rider. Again, it's not term insurance, but that actually gives us capacity. A lot of people don't realize this, but just like with a 401k or even a mortgage deduction, there's only so much you can actually put into a whole life insurance policy before the IRS goes, whoa, wait a second, Stephen. This is not for widows and orphans, buddy. We can tell you're just using this for a tax shelter. And that is based on how much death benefit the premium buys. And so to kind of artificially inflate how much money we can put in, we buy more death benefit with the term insurance rider. But most business owners need it, again, for key person protection, maybe a buy-sell agreement between partners. So it's not just wasted money, but it's a way for pennies on the dollar to be able to inflate how much premium you can put in. And when you put in extra premium over and above the ordinary life premiums, it goes to something called a paid up additions rider. And so all a paid up addition is, hence its name, is it's like a little mini ordinary life policy, but instead of paying for your whole life, it's paid up in one shot. So it's like really front loaded. And you could do that on its own with a whole life policy. But again, the IRS will go, oh, Stephen, this is a great looking policy, but buddy, this is not for widows and orphans. You didn't buy enough death benefit. And so between the term rider inflating, call it, I did this once with a FedEx envelope. I got a big FedEx envelope and stuffed cash, one of my videos. You're inflating the amount of capacity that the whole life policy can take on, and you're buying little mini turbocharged whole life policies with this paid up additions rider. But it's really all the same thing, Stephen.
Interesting. Okay. So we have that. Okay, you made reference to lines of credit, and some of our business owners, they don't even have lines of credit, and they're not sure to how to even go about that for their bank. How much should they ask for, and what's the process of like walking into their bank and saying, hey, I'd like to line of credit? And is there anything that they should look for in that line of credit?
Yeah. So again, I'm not a banker, but I have known several over the years. And it starts with just going to their own bank and seeing what they can qualify for. How much should they get? As much as they can get. I mean, you don't have to use it. It's just access and capacity, optionality. Yeah. So get what you can from your existing bank and then go shop around, right? Yeah. Depending on where they're at in the country, some of the smaller regional banks are going to be a lot more aggressive with local businesses that they feel they understand. And so I would take your one in the hand, get what you can get from whoever your existing banking relationship is, and then go out to the bushes and, have your numbers straight, show the business owners, show the bankers that your business is cash flowing quite nicely, and see what you can get in terms of a business line of credit, maybe refinancing some of those equipment loans to where there isn't as much urgency to pay them off. That's where I would start. And then again, so I call this 4D banking. In fact, we have a special site that leads to that content. It's number 4D, like four-dimensional, 4dbanking.com. And then it's really almost like a personal audit, a personal appraisal of the different accounts and assets you already have in your life that we're kind of trained by the financial industry to just kind of set it, forget it. But when you're a business owner, again, your best investment is going to be this little micro cap stock, this little med spa that you own and control. That is going to be your best investment. So I'm not saying to cash out your investments, but all of them have their own liquidity profile. A lot of them have borrowing mechanisms, whether it be a brokerage account, like if you bought some Tesla stock, usually people have little E-Trade accounts where they bought some Facebook or they bought some Tesla or whatever. You can actually borrow against that. Now, it's not as safe as borrowing against insurance, but we talk about having a network of different assets. And then you can maybe borrow against some of these if you have the backstops of those 401k loans, maybe a HELOC, a home equity line of credit, maybe your insurance policy, but really doing an appraisal. And that's something we can help with to help people understand what they have better and to really understand the pressure points of how much they could safely borrow against their own assets without having to cash them in.
There's a lot of, you probably, and this is for the people listening, you probably have a lot more money at your disposal than what you realize, especially as a med spa owner specifically. Okay, so one of the simple formulas that I found with it, a line of credit starting point is like 10%. Generally, they'll give you like 10% of the gross revenue for your business as a line of credit. So if you're doing $1 million a year, $100,000 is normally like a good starting place. What Hutch was saying, like you certainly can get more than that from some banks, depending on how much they want. But I found that as a good rule of thumb. And to Hutch's point, like I'm shopping banks now because I found myself straddling 4 different banks because the one bank I initially started working with, they stopped trying to win my business. They're like, we already got them. Right now we have 4 companies and all that. And it's like, all right, I need to simplify my operations. So I take my banks, I'm shopping it around. I let them all know that I'm shopping and they're giving me better rates. They're kind of like, all right, well, I mean, it normally costs this, but we're going to knock it down to that, because they really want their business or our business. So Hutch, for you talked about using whole life insurance in order to retain talent. And I really loved this strategy. So keeping it top level and simple, like our front desk person is a key person. And if you've got a great front desk person as a med spa, like they are your quarterback. They are so good and valuable. You don't want them to leave because they help grow your business. They know all the operations. How do you do a little bit of golden handcuffs with them through a whole life insurance policy and while benefiting the business in the process?
Sure, that's a great question. So one of our key videos on our site is "Don't do what banks say, do what banks do." And what we do is we look inside the balance sheets of major banks, and what you find is banks have billions of dollars of cash value life insurance on their books, not death benefit. It wouldn't show up on a balance sheet, the death benefit, until somebody dies. The cash value showing up, and these are tied to key executive comp programs. And so there's a lot of different ways to skin the cat. So I don't want to get into details. But long story short is by giving them a future promise of some kind of bonus, and that could be short-term promise, it could be a long-term promise, it could be a combination of both. You can really get very creative, and this can be very, very bespoke, customized for the employee. And unlike a 401k, which is kind of a group hug, you got to kind of do it for everybody. You pick and choose who you do it with, who you do it for, and the plans can be different for each person. But the banks have these key person life insurance policies where if the key person were to die, the bank owns the policy. The bank is the beneficiary of the death benefit. And so the bank is made whole, or in your case, the med spa is made whole because you actually have a loss. If you lose that key person quarterback, that front desk relationship manager, that is going to have an impact on your business. And an insurance company will absolutely give you a policy. Now, you have to get their permission. And this is actually interesting. If you go to Google and you type Walmart life insurance lawsuit, Walmart liked this idea so much that they started taking out secret policies on like cashiers and janitors. You can't do this on rank and file. You have to do it for a key person. And the insurance company has to has to underwrite them. But now, because of that, there's a Form 101J. They need to know that the employee actually is giving consent to the company owning a policy on them. And once you do, that's property of the company for life. And really, all the policy is it's two-pronged. One is it is key person protection for the company. You can promise that some of that to the employee themselves, just like there's group life insurance. You can do individualized and say, hey, by the way, if you pass away as part of this, you taking up this policy, we're going to give your family 2 times salary or whatever that looks like. But really, the mechanics of it is the med spa gets paid the death benefit, and then the med spa pays out that death benefit, which at the time is deductible because they receive the death benefit tax-free, but then they make a distribution, which is essentially compensation, right? And that's deductible. The other reason why the banks have all this insurance is because the employees, to feel good about it, want to know that it's backed by a liquid asset. They don't just want this promise, right? And so it's really, when you make these promises of a bonus or future bonuses or some kind of pension or whatever it is, the company's accruing a liability, right? And in fact, your bankers will look at it as such. Like, you have this liability, you owe this employee X amount or whatever formulaic thing you use. And so both the employee and the bankers themselves like to see an asset that's also tracking along with the liability to make sure you're balance sheet neutral. So there's lots of ways to skin this cat. I don't want to get into the details.
Yeah. But what I like about it, and the thing that got me was, I was like, oh, okay. So for a key personnel, I could put a whole life insurance policy on them. I'm paying it throughout, their history with us. I could borrow against that, just like what we were talking for infinite banking. And then I could say to that employee, hey, you retire here and I will give you 5 years of your salary. I mean, depending on how big the policy is, like for after you retire, 5 years, I'll continue to pay your salary.
Yep.
Well, that employee, when they're thinking about leaving, they're like, okay, I'm walking away from 5 additional years. So I'm going to still continue to get paid normal until I'm 70, and so it causes them pause, right?
That's why they call them golden handcuffs.
Yeah. So I really like that strategy. And for the employee, the win is like with a 401k, they're coming out of pocket to contribute. And like for the whole life insurance, they're not contributing anything. It's all on the business. But like the business is also getting some benefit while keeping that key person in place. And I think it's a win-win for everyone because most people aren't great at saving. So this gives them an extra, I mean, it could be 3 years, 5 years, 10, like whatever you feel comfortable with and however much money you got. So I just really love that strategy, and it could be used for a top injector or a front person. It's just such a good strategy.
Do you mind if I
Please.
tie that back to owners? Because I think this is something that is overlooked by owners. So obviously owners have tons of insurance. They have insurance out the wazoo, right? And nowadays there's like tech fraud insurance and, everything under the sun. You guys are paying for insurance. What they don't often have is their own key person insurance, or when there's partners in the business, something called a buy-sell agreement. And a lot of times business owners collapse the two as the same, but they are two distinct. So if you're a single owner, whether you're a single owner or a partner, oftentimes the owners themselves, if they were to go down, if they were to pass away, there would be a serious loss incurred to the business, and the value itself would go down, or the other owner would have to step in and double time and everything else. And so having that key person insurance owned by the company, where if they were to pass away, there would be an immediate, call it loss of value, but now there's an influx of cash to buy time, to lure new talent to help the other owner, or if it's not an owner, it's just a family at home that they don't know how to run a med spa. At least it's tied to part of a succession plan. So I think that is vastly, vastly important.
Yeah.
Go ahead.
And there's the other thing about, like, if you're being bought out, there's a lot of PE, private equity money coming into the industry. So they would see that as like, oh, this is a really valuable asset.
Absolutely. So with your key injectors, with your front desk person, and even yourself, a lot of times these buyouts, we're seeing them too. A lot of times it comes with an earnout to where you're getting bought out, but you still have to work in the business for 2 or 3 years, and you have to hit
Yeah.
certain numbers to get the back end payout. They love to see that these plans and these policies are in place because in their mind, it is insurance. Like they're
Yeah.
insuring their investment. And so
Mm.
absolutely it helps with valuations if you're looking to get an exit in a liquidity event. Why it's so important for partners is if you had a partner, and I ask it this way, if you had a partner in the business and you were close with their family, when I ask clients, so you know the family, but would you want your partner's spouse as a partner if your partner were to pass away? The answer 90 some percent of the time is no, 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 no,
Yeah.
no.
No.
Like them, go to dinner with them, we'll see them at events, don't want to partner with them in a business, especially when emotions are heightened and grieving is taking place. And so what
Yeah.
a buy sell agreement is it's a legal contract that most of the time won't get executed. But I call it like when you were a kid on the playground, like there's one cookie, I cut, you choose. The terms and conditions are fair either way, to where everybody kind of agrees upon either a fixed value or a formulaic value at the time. And it obviously needs to be revisited at least every year, maybe more if things are growing. Maybe you could let it go for a couple of years, but to have something in place, an agreement is one thing, that's a promise. But if it's unfunded and a partner were to die, well, again, we talked about how the business is going to lose value, or the surviving partner is going to have to step up and double time just to keep up with the numbers. And
Yeah.
so to have a policy, these policies are usually not corporate owned or company owned. They're usually owned by each other. It's called a cross purchase agreement. So if you and I were in business, we are going into business on a SPA, Stephen, you would own a policy on me and I
Mhm.
would own a policy on you. And it doesn't
Mm.
have to be whole life for infinite banking. It can be. It can even just be term insurance.
Yeah.
To just know that if I were to pass away, you don't have to have Mrs. Hutch or Hutch's kids if Mrs. Hutch and Hutch passed away in a car wreck together. You don't have to have non-involved emotional family members
Yeah.
as a partner in your business. Like there's at least a big cash lump sum to have as a down payment, and maybe with a little bit of earnout. And then hopefully there was a key person policy to where it takes the pressure off the business, or you can hire some other talent so you're not working your butt off.
Yeah. It's so good. There's so much more I wanted to talk about, but I'm like looking at the time and we're already about 20 minutes over.
Oh,
Um,
gee. Sorry, Jim.
but no, it's really
Oh, God.
so good, and you can. There's so many layers to it, but as everybody can tell, this world of finance and leverage and it's very complex. So I'm sure the MedSpa owners watching are going to have questions. I know I have a lot more questions. Uh, how can they like hire your company, contact your company to like help them navigate this crazy world? And like, what are some of the little things that maybe you do help them with?
Sure. So, like, obviously, our core business is helping people understand infinite banking and then getting them custom fitted with the proper insurance policies. Whenever we're dealing with a business, there's a lot more variables and everything else. But if people are genuinely exploring this, then that's what we do for a living. On our site, bankingtruths.com, there's a lot of content. And I realize not everybody's ready to talk to a human yet. They want to do a little more research. Fine. Bankingtruths.com. We have the biggest library on infinite banking, how insurance policies work. Some of the more advanced strategies, we do have 4dbanking.com. But in terms of dealing with the business, it's not really everyman content. So we don't necessarily have that out on Front Street, and that is more of a bespoke conversation. There are schedule buttons all over the site. You can jump on and schedule. What I would say is if you found this interesting and you want to discuss, I'll just give out my personal email. It's hutch@bankingtruths.com. My calendar isn't on the Front Street. I have several team members that help. Oftentimes they bring me in if it's warranted, but if you're part of Stephen's listener base, I'm just putting it out there. You can work with me directly. I will always work with one of my team members, but at least I can help oversee the architecture. So I would just recommend emailing me first at hutch@bankingtruths.com, and then I can give you the proper schedule link from there.
I appreciate it so much. Thank you for your time today, and thank you all for listening. All right. Take
Yeah,
care.
thanks for having me, Stephen.